everybody, yet to another episode of the Dental Boardroom Podcast. So, I am finalizing my series on cost segregation, a very cool strategy when used appropriately if a doctor owns both their practice and the building and owns them 100% each. Or if there's a partner, both the practice and the building entities are held in the same pro rata ratio between those two partners. What I want to talk about in this episode is a little more complex. I'm going to try to distill it down so you understand it. And if you own your building, this is actually an incredibly important concept, and you will definitely impress your CPA if you follow me on what I'm about to share in this episode, which, by the way, is a little bit of a clarification on a couple points from the prior episodes. It was an area within self rentals, and I didn't really dive into the uniqueness of being both the landlord and the tenant at the same time. Meaning, your dental practice, generally an S corporation, or if you have a partner, it's a partnership, is the tenant of the uh, building that is owned in a separate LLC. And this doesn't work if you have a number of other tenants, but most dentists, they're the only tenant of the building that they bought. So if you own your practice and are buying a building, now, if you already bought a building and you didn't elect what's called grouping, which is what I'm going to go into here shortly, then it's too late. This is only applicable if you are buying a building, and in the year of buying that building on that first tax return, you are electing to group that building with your dental practice as one single economic unit. All right, so that's a little bit of a preface. And then if they are operating as a single economic unit as opposed to two separate economic units, then there's a certain benefit and there's certain disadvantages to electing to treat them as a grouped unit. So try to follow me along here. But for those of you watching on YouTube, I have my screen sharing. I'll narrate it for everyone else. And I want to start off by talking about a key concept in tax for you real estate people out there. The income from a rental real estate property that you are renting out. Let's just start off and say it's not yours. You're not the tenant. You're renting it out to somebody else. That rental income is passive. It is passive rental income. And the losses are passive losses. And the IRS says they are passive because you are not actively participating as a real estate professional in the management of those properties. Now, you heard me talk about in my last episodes the challenge it is to be classified as a quote real estate professional in the tax code. You have to be working 750 hours. It has to be your predominant profession that you're spending your time on. There's all these rules, and it's virtually impossible for an active dentist running a dental practice to claim themselves as a real estate professional. That's why I brought up the possibility of a spouse who may not be fully engaged in, let's say, a W 2 job somewhere and is doing real estate in helping manage your real estate property, or they are a real estate agent and that's what they do for their day to day job. When you have that scenario, then you collectively, as two spouses operating as one tax unit, because you file a single tax return called the 1040 tax return, then you both get the benefit of being labeled as a real estate professional. And if so, then you can take these losses from your building, especially losses that aggregate in the first year because of the cost segregation study that was commissioned and generated huge losses in that first year. Those losses can then be used to offset any other income you have, like W 2 income or K1 income from your corporation, or if your spouse has W 2 income, you can offset that active income from, or what's called earned income, by deducting the real estate you're building losses against that income. Now, normally there's this big wall between those two.
Do you ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, Practice CFO, just for you. With almost 2 decades of experience, Practice CFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the x-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or Chief Financial Officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
And the losses in your building that accumulate because all the depreciation, the interest payments, but especially that depreciation, and especially if you do that cost segregation, it front loads a lot of the deduction of depreciation in the first year. That will create a loss. This is very common to have a loss in the early years of owning your building because of the depreciation, especially when you do that cost segregation and you take bonus and accelerated depreciation. Now, normally there's a wall that isolates that loss off. It partitions it off and it says you cannot leak that loss to offset your active income like your W-2 and your K-1, your earned income. You can't do that. And so that loss that gets sort of siloed off, put in a bottle, is called suspended loss. And it's suspended until your building LLC starts generating a taxable profit. When it generates that taxable profit, you can release those losses against the income in that. Now, also, here's the other thing. If you have other real estate properties outside of the building that you are operating in, a true, let's say, residential rental down the street, or maybe you own a duplex or even an apartment complex, with 8 doors. If you own this other real estate over there, and that is generating positive taxable income, you can use the losses from your building LLC for your dental practice. You can take those losses from the cost seg and reduce the income from your other rental properties outside of your practice building. And with that in mind, that concept in mind, let me now explain that the standard process or the standard profile when a dentist owns their building is they don't group the building with their practice as a single economic unit. So non-grouped. Here's what the non-grouping does. If your LLC owning your building has positive taxable income, that positive taxable income is not called passive. It's actually called non-passive. And the reason why is because you are renting it yourself. You are the landlord and you are the tenant. And that is called a self-rental. Really important term, self-rental. Your other real estate property down the street or by your house or whatever, that is not a self-rental. You're not operating a business out of that. That is a true rental. And that income over there is passive income because you're not operating in it. Your building is not passive income. It is non-passive income. And so if you have losses in your outside real estate, you cannot use the income in your building LLC for your practice. You cannot use the building LLC income to reduce or offset the income or the losses outside of your practice. So let me state that better. you have, let's say, I'm going to use a simple low number. You have $10,000 of income in your building LLC. So the LLC that owns the building that you operate your practice in, that real estate. Let's say you have $10,000 of income. And let's say in your rental duplex down the street, you have a $10,000 loss in that one. Well, guess what? You can't net the two. You can't take that loss on the duplex down the street and reduce the $10,000 income, taxable income in your building LLC. You can't do that. Why? Because they're characterized differently. The rental income from the duplex is passive income, or in this case, a passive loss. The income in your building LLC is that's the operative word, non-passive. And you cannot net non-passive income against passive losses. They have to be characterized the same. Now, the other way is not true. So let's go with the same scenario and just reverse where the income and losses are. If your duplex is running a positive $10,000 taxable income, a positive $10,000 taxable income on your Schedule E, page 1, you have $10,000 plus in your duplex, and then your building has a $10,000 loss. Guess what? The loss in your building LLC is passive, and the income on your duplex is also passive, which allows you to offset those two together and pay no income, therefore, on that duplex taxable income of $10,000 because you use the $10,000 of losses from your building LLC that you operate in against that duplex income. And so there's an asymmetry that occurs here. And the asymmetry for your building LLC that you practice in has income is labeled as non-passive and losses are labeled as passive. And those losses can get trapped. They can get trapped if you don't have that duplex down the street and your building is your only LLC, which is the most common scenario I find with dentists. That loss in the building LLC gets trapped. It gets suspended, it gets put in a bottle, and then in the next year, if you have actual positive taxable income in your building LLC, then that prior year bottled up loss gets emptied out and it will reduce the loss in the new year when you have, it will reduce the income in the new year. And so the key thing here is that cost segregation and depreciation allows you to shift tax benefits from the future into today. And the benefit of that is simply the time value of money. A dollar in your pocket today is worth more than a dollar in your pocket in 10 years. It could be worth twice the value of a dollar in your pocket in 10 years to get that dollar in your pocket today. So this is a time value of money benefit where you're trying to pay the IRS less now and down the road you'll pay them more. At the end of the day, you'll pay them the same amount, all other things being consistent. But because you're paying a dollar less today, that dollar that is now in your pocket, theoretically, you invest that at 10% rate of return over 10 years, that $1 might turn into, $2, $3, and then you pay the IRS a dollar in 10 years, and you just pocketed the difference. That is the beauty and the benefit of compounded growth and the time value of money. And so cost segregation and depreciation and tax management is so much about managing when you pay the IRS and getting the benefit of deferring paying the IRS. That's true when you put money in a 401k. That's true when you put your money in an appreciating stock that just appreciates in time and you only pay the taxes on that when it sells. So let me come back now to my screen, and I've got two boxes here. A scenario where there is no grouping of your building LLC with your dental practice S corporation. No grouping. The second one is where you group them, and the LLC and your S corporation. Now, granted, your dental practice could be, some states allow an LLC, but it files almost every time as a corporation, as an S corporation or sole proprietor, but generally as an S corporation. So don't confuse an LLC with your building and an LLC of your practice if you're in a state that allows dentist practice to be held in an LLC. Don't confuse those as the same thing. What matters here is what the IRS gets as a tax return. And there is no such thing as an LLC tax return. So your LLC dental practice is filing an S corporation, and your LLC building entity, assuming you don't have partners, should file as a disregarded LLC and go straight on your personal 1040 tax return without filing a separate tax tax return. Okay, so on the left-hand side, without grouping, this is the most common because a lot of times dentists don't know about it, and so they don't do it. Their CPA isn't proactive and addresses it. And there's some scenarios where it doesn't make sense to do it because of other extenuating reasons. Maybe there's other real estate properties out there with their own nuanced tax situation. So this is absolutely something to talk with your CPA on. My main point is you may need to be the one to initiate that conversation because your CPA is so busy and doesn't generally do a lot of deep strategic planning. They're just trying to get tax returns out the door on time and do it accurately. Most CPAs are not really planners. So that's why here at Practice CFO, we lead. Everything is about the planning. That's why we're certified financial planners. That's why I started it all with the finance aspect in mind. Finance is forward looking. Accounting is historical looking. The accounting gives the x-rays to then do that forward-looking strategic planning. So make sure that you recruit your CPA because they understand this. They just need you sometimes to prod them to do the analysis and tell you whether or not it's a good idea to group your building LLC with your practice S corporation. So let's go over to the grouping. When you group, so again, when you don't group your building LLC with your practice, all rental income is non-passive and all rental losses are passive. And that is a scenario that is detrimental to you as the dentist. But when you group it, it creates symmetry. All the rental income in your LLC owning the building is non-passive, and all of the rental losses are non-passive. So it's treated from a tax standpoint much more like your S corporation and unlike your duplex down the street, which is all passive income, all passive losses. When it's grouped with your practice, your building LLC becomes all non-passive income and all losses become non-passive losses. Now, the passive losses are passive whether or not you group it with your S corp or not. That doesn't matter. It's only on the income side that you create symmetry now. When you group it, your building LLC income goes from being non-passive to being when you group it, sorry, it's on it is on the loss side. My bad. It's on the loss side. Your rental LLC that owns your building, when you don't group, that is non-passive income, but the losses are passive. I know it's a little challenging to follow, but the losses are passive. When you group it with your dental practice as one economic unit, the rental income still stays the same as before. It's non-passive. But the losses now become non-passive, which releases the trapped losses when you have losses in your building. They get trapped. Remember, I mentioned they're suspended and put in a bottle, and you can't use them in the current year, and you can only empty that bottle later when your building has positive taxable income. Well, guess what? When you group it with your S corporation, those losses in your building LLC, you can use them. Here's the point. You can use those losses now that they are labeled as non-passive, like the other non-passive elements of your S corporation, which is your W-2 to yourself and your K-1 income out of your S corporation. Those are both non-passive because you are an operating dentist. You are working in that S corporation. That is an active earned income. So your W-2 and your K-1 are active earned income. Now, this is where the beauty comes in. Of course, as mentioned in my prior episodes, you can take those passive losses from your building LLC, and they're now categorized as non-passive, and you can release them to offset your W-2 and your K-1. So if you do that cost, so you buy your building, you commission a cost segregation analysis, you hire a good firm to do the study, you front load $400,000 of bonus depreciation from the cost segregation study in your building LLC. Now you're sitting on $400,000 of losses in that first one. And let's say you're cranking it. I'm really going to use an exaggerated example here. Maybe you're cranking it and doing $1 million take home between W2 and K1. Maybe it's $300,000 W2, $700,000 K1 out of your S corporation, that $1 million. Now you get to reduce that $1 million by the $400,000 loss in your building LLC. So now you're only taxed on 600,000. And that extra 400,000 was going to be taxed at somewhere around 37% on the very low end for states that don't have income tax. And for states like California and New York, you got to add another 10% roughly to that. That's like 47%. So you get to save almost 50% on that $400,000 reduction because you used the losses from your building to offset your W2 and K1 from your S corporation. And that is saving you somewhere around 200,000 bucks in that first year. Now, there's other factors that can seep into the analysis from a tax standpoint, but in a clean scenario where the dentist only owns their building and they only own their dental practice, and the building is an LLC that does a cost seg analysis, and the practice is an S corp, or it doesn't have to be an S corp, but the ownership is the same between the building and the S corp, then you can elect to group it in the first year, and you have to do this in the first year.
Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do two things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of Practice Orbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to Practice Orbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system, from listing the practice to NDA to LOI, and finally to closing the deal. Create your free account today at www.practiceorbit.com.
Of buying your building, you tell your CPA, I want you to group my building LLC as, or I want to group it with my S Corp. So it's treated as one economic unit. And this resolves that asymmetry permanently. Both sides of the ledger now become consistent. And you cannot go back on that unless the rules allowing the grouping break. Let's say you sell your building. If you sell your practice, but not the building, that breaks. And now you're not allowed to group. But without something structural changing that, you cannot ungroup this down the road. And there's pros and cons of grouping. I'm going to go over each of those pros and cons here in just a moment. So let me summarize here. A dental practice operating in a building owned by the same person in a related entity checks every one of the boxes required in order to treat the building and the practice as one economic unit. And that's almost in every case, it's because all of the requirements are met allowing them to be grouped. There's common ownership, there's common control, there's geographic proximity. They're the same thing, essentially. The practice is in the building. And there's economic interdependent. Those are the four rules in the IRS tax code. And so a dentist who owns their building and operates in their building and is the only tenant satisfies every single one of those. Very easy, slam dunk, not even an audit risk. Okay. So let's come down to the practical mechanics of applying this. Timing, disclosure, binding, and IRS authority. Let's talk about timing. When to do the grouping. And I mentioned, and I'm going through my slide here, so there's a little bit of repeat, but this is a complicated subject, so maybe a little bit of repeat is good. Timing, you must make that election on the original return for the first year of the building activity begins, i.e., the first year that you bought it. So if you bought it in February of 2026, then your 2026 tax return, when filed, and sometime around February, March, or April, uh, on that return, it should be elected that it is grouped with the S corporation. You cannot make that retroactively. Next, disclosure. It is critical to attach a statement to the tax return identifying the grouped activities, and that is with Form 8582. So go to your CPA. Hey, CPA, I just bought my building. I own my practice. I own my building. Those are pretty much the two main things that I own besides my house. And I want my building and my practice, my newly owned building, to be treated as a single economic unit. Can you do that by electing the grouping and attaching Form 8582 to the IRS so the IRS is aware of that? Now, the IRS may say, well, the tax preparer say, well, have you thought through this? Well, good. Sit down and have the tax preparer look at your global financial situation and tell you whether they agree with that. And if they don't agree with that, it can't be some general comment like, oh, well, there's some risks with this, blah, blah, blah. No, state exactly why they are recommending that you don't group your building LLC with your practice. You want reasons for that. Okay, let me try to give you one reason possibly. If a doctor buys a dental practice and a building at the same time and groups those, usually the doctor who buys the dental practice, and let's assume this is their only dental practice, they run a very low income typically in the first few years because there's already a lot of depreciation in the practice S corporation already. You don't need to pull from the cost seg deductions in the building LLC and transition them over into the S corp to reduce income in the S corp when your S corp already has low income. So I don't want you to front load deductions from a cost segregation study when you're already in a low tax bracket. I'd actually rather you punt the deduction from your building depreciation to future years when your S corporation is cranking it and pushing you in a higher tax bracket. So that's one reason. The best scenario is doctor buys a practice, not the building. They run it 5 years later. They're really cranking it. They're getting into the highest tax brackets or maybe deep into the highest tax bracket. Now they buy their building. Now they commission the cost segregation analysis. Now they front load the depreciation through bonus depreciation. Now they group the building with the S corporation. Now they take that huge loss from the cost segregation. They swing it on over to reduce now the high taxable income coming out of the dental practice from the W-2 and the K-1. That's the best scenario. And the beautiful thing is that's the most common scenario because buyers typically can't afford the cash down, the 20% cash down to buy their building, but they get a first right of refusal in the process of purchasing the practice, assuming that the seller owns both the building and the practice. They get a first right of refusal such that down the road, if the building owner, the seller of the practice who owned the building, the seller decides they want to sell the building in 5 years, well, the dentist who bought the practice now has the first right. They're the first one in line to be able to buy that to buy that building. And if they do buy the building, they're now cranking it in the dental practice, taking home a bunch of money, high tax bracket. Now they do the cost seg, and now they reduce their overall income and really get the benefit of the time value of money on getting the tax benefit. So that is the benefit. I just summarized that in a nutshell, but if you didn't follow that, rewind it 1, 2, 3, 4 times, whatever. You need to understand the past roughly 2 to 3 minutes of what I said there to understand the whole concept here. So back on my slides here, disclosure, attach a statement on the tax return, identifying what is the grouped activity. The dental practice and the building LLC, that's the grouped activity. It's one single unit, one owner, owns 100% of each. Geographically, they're the same unit. Everything is the same. So that's an easy explanation. All right, next item is binding. This is binding. This is a binding election when you do that in the first year of owning your building and attaching that 85, 82 disclosure statement to the IRS. And so it's generally binding in all subsequent years. You can only be changed if there's a material change in the facts and circumstances. And then lastly, the IRS authority, it's under section code 1.469-4F. Don't worry about that. But under that code section, the IRS can ungroup if the election circumvents certain passive activity rules. But a legitimate, in other words, all that's saying is that the IRS has the ability to audit these, and they audit a lot of these. It is true that even if you're squeaky clean, it could raise an eyebrow or could put you a little bit on a radar at the IRS. And if they come in, normally they'll keep a limited scope audit and just look at this grouping election and validate that it's substantiated per the facts and circumstances. The worst case scenario would be this would be their foot in the door, and then they say, okay, your grouping is good, everything checks out there, but you know what? While we're here, we're going to look up and down your P&L and your balance sheet, and we're going to do a full audit. That typically doesn't happen, but it could. So there is a slight IRS audit risk that goes up here. But as with many things, if you document this right and you follow the rules and you use the rules to your advantage, then you should be okay. All right, let's go to the pros and cons here. The pros of this grouping election. The pros of this grouping election, there's 5 I'm going to indicate here. The first one is loss utilization. And this is just a repeat of the main theme and benefit. Early year losses from your building LLC, which are accentuated from the cost segregation work. Those losses in the building LLC can offset your W-2 and K-1 practice income dollar for dollar instead of being locked up in that bottle, suspended as passive loss carry forwards. Number two benefit, cost segregation amplifies it. So the first year bonus depreciation from cost segregation study becomes actually usable in year one. So I sort of lumped that in the first benefit, but this is really a key benefit to call out separately, is that even if you didn't do a cost segregation, when you bought your building, there's probably enough depreciation there in that first year that you may have a loss, but it might only be like a $15,000 to $20,000 loss. And you can use that to offset your W-2 and K-1 when you do the grouping election. If you do the cost segregation, you might take a $20,000 loss and amplify it to $200,000 or $300,000 loss in year one. All right, so the third benefit, it fixes that asymmetry I talked about on the losses. Remember, if you don't group your losses in your building LLC, they are non-passive losses. So you cannot use those losses if you have income from outside rental property like that duplex down the street. It creates an asymmetry between the income and losses inside your building LLC. And so it makes both of them. There's no way that you can make as a self-rental of your building, as a self-rental, you renting it. There's no way to make the income and losses of your building LLC both passive. There's no way to do that. But you can make them both non-passive. That's the key thing here with the grouping. And when they're both non-passive, now you can take those losses from your building LLC and again, offset the W-2 and K-1 from your S corporation. Sorry if I repeat myself, but this is a complicated subject. So it fixes that asymmetry. It eliminates the unfavorable self-rental dynamic where income is taxable, but losses are trapped. Let me say that again. This fixes the asymmetry when you elect the grouping. It eliminates the unfavorable self-rental dynamic where income from that rental LLC is taxable, but the losses are trapped and not deductible until future years. Moving on to pro number 4, simpler participation. When you elect a grouping, once grouped, you have one material participation test on both the practice and the billing together, and it becomes very clear that these two things are running together, thereby allowing them to be treated as one economic unit. And so income in one can offset losses in the other, and losses in one can offset income in the other. They're treated as one. So it's taking those losses from one jar and taking the income in a separate jar and taking the losses out of the one jar and putting them in the income of the other jar. And so you have both income and losses in the same jar and they net. That's the beautiful thing here. All right, and it when you elect the grouping, it keeps that very clean and simple and defendable. All right, pro number 5 is predictable treatment. Once in place, there's no annual passive activity tracing or carry forward management. So remember those suspended losses that get bottled up in your building LLC? You have to track those from year to year and how much gets released. It's like you're keeping a ledger. How much suspended losses are there to still use? That whole thing goes away because you're assuming that you have enough W2 and K1 income from your S corporation to fully absorb the losses from your building LLC. If your building LLC has losses of 200,000 in year 1 from the cost segregation analysis, but your W2 and K1 from your S corp are only $100,000, you're only going to be able to use $100,000 of that $200,000 loss. And the other 100,000 is still going to get suspended and carried forward. So that's why I say if you're in a low tax bracket in your S corporation, meaning your W2 and K1, if your W2 and K1 in your S corporation combined is less than 150 or 200,000, you're already in a pretty low tax bracket, especially if you're doing married filing joint and your spouse doesn't have any income. You're in a fairly low tax bracket. Not much need to accelerate future deductions from cost segregation into the current year to offset that income when it's already being taxed as a pretty low rate. I'd rather you pay the taxes this year at the pretty low rate and then use the deduction from depreciation in your building to offset your W2 and K1 when your W2 and K1 were a lot higher. So the general rule is a tax deduction today is better than a tax deduction in 10 years. The only caveat is that if your income is a lot lower today, then your income is going to be a lot lower in future years, thereby putting you in a lower tax bracket today. Let's say the 22% tax bracket, when in 10 years you're going to be in the, I don't know, the 45% tax bracket. You may not want to fully deduct that cost segregation and spread it out over time. So there's a lot going into that analysis. Make sure you recruit your CPA to do that analysis. Okay, let's now look at the cons of the grouping election. It's a one-way door. It's it's you cannot change this. It's binding. You may be you may be able to ungroup later if the facts and circumstances change. And I'll go over a couple scenarios here. So, but this is a one-way door. Number two, as a disadvantage here of the grouping election, is partial sale complexity. If you sell the building alone, so selling the building alone may not trigger a full disposition of the grouped activity. Suspended losses may remain trapped. So if you sell the building alone and it triggers a full disposition of the grouped activity, suspended losses are going to remain trapped. So when you have a bottom line here, when you have a partial sale, and you only sell the building, uh, you and that building is going to create some income. If you have losses, maybe losses from your S corporation, you may not be able to combine those two. So it does create complexities or tax complexities when there is a sale of one of these two economic units, the building and the S corporation. That one definitely is an area where you need to have a serious conversation with your CPA because it gets a little more complicated. Number three, you forfeit passive shelter. So future net building income becomes non-passive and can't absorb passive losses from other investments. So once you make this election, remember in my earlier scenario where I said you have the duplex down the street, and that's passive income, passive losses. Your building, if you that you own, if you group, they're both now non-passive. And so before I said if you don't group, the losses in your building LLC are passive. And you can deduct your losses in your building LLC against the income from the duplex down the street. You can do that. But once you group, you can no longer do that because the losses in your building LLC are now non passive. They're non passive. And therefore, you can't deduct losses in your building LLC against the duplex income down the street. And so that can come back and hurt you if, let's say, you don't have a lot of income in your S corporation to offset the losses in your building LLC, but you do have income in your duplex down the street, or your apartment building down the street is creating a lot of income. You can no longer reduce that income from the losses in your building LLC because you grouped your building with your practice, and you can no longer treat that economic unit of the building and the practice together against, or in the same jar, so to speak, against the outside income from your duplex or other outside real estate entities. So you forfeit that passive combining of your building LLC with outside income from other real estate properties. All right, con number 4, DSO or partner disruption. So if you bring on a partner, an equity partner, like if you're selling to a DSO and they buy 60% or whatever, even if there's a management entity and you still own 100% of your stock, yada yada, it's treated, the substance of the law is you sold a portion of your practice, and now you break the compliance with the rules required for the grouping election. And once that happens, it forces an unplanned decoupling of your building and your practice. And now you have to go back to the way it was before. Now, that may be okay since you don't own your practice anymore. You may not be getting anything but a W 2 at this point. You essentially are making a lot less money in the corporation because now you're an employee of the DSO, and you may not therefore need a bunch of losses from the building to offset your now lowered income from the building. So you may not need the grouping to be in force at that point, anyways. All right, here's another one. If you're into real estate at all, you know about 1031 exchanges. 1031 exchange allows you to sell your rental property and not pay any taxes on the gain of that sale if you roll the proceeds into a newer property entirely. So if you do that, it's as if you never even bought or sold to the IRS. You're simply taking what is called your tax basis in the property you sold, and it becomes your new tax basis in it carries over into the property that you just bought, and you're effectively deferring paying taxes on the appreciation of your rental property. And so, but when you group it, now you're building LLC, it's like your practice. It's an operating active thing now. And the 1031 exchange is only allowed for passive rentals, into selling those in putting the proceeds into a new passive rental. So when you group, it adds complexity when you're analyzing the grouped activity during and after a like kind exchange. It's not to say you can't do it, but there's some absolute complications there that you need to talk to your CPA about. I think this works the best when your only real estate property is your building. If you're on target to own 5, 6, 7, 8 other outside rental properties, it may not be the best thing to group. Again, talk to your CPA. And lastly, number 6, semi-retirement trap. If the practice winds down, rental income stays non-passive, potentially a disadvantage when passive treatment would help. So what I mean by that is, if you slow down in your practice and you go from taking home 500,000 a year to taking home, I don't know, I'll accentuate here, $50,000 a year. Now you don't have a lot of income in your S corporation. You don't have a lot of income. Now, maybe you're building, you've owned it for 10 or 15 years, and the market rate rent is just a lot higher. It's making really good cash flow now. You've run out of your depreciation, and so there's a very high taxable income now in your building that you have. You um, there the benefit of grouping really goes away there, and it can become a potential disadvantage when that happens. It really only is the advantage when your W-2 is a lot higher and your K-1 is a lot higher from your S corporation. But when that goes away, you're not really getting any benefit from doing this. And now all of your income and expenses in the billing LLC are non-passive, and you can't really combine them with outside real estate as well. Okay, so those are the cons of grouping election. And so let's just look at a couple scenarios here and we'll end off with that. Building, so early years, you have a lot of building losses. Without grouping, you are unable to use those losses against practice income. So a little bit of a summary going on here. When you do group, you can take those losses in the early years and you can use them against in practice income. So without grouping, which is normally what I see, those losses are trapped. With grouping, those losses are released and they are usable against practice income. Okay, scenario, cost segregation benefit. You get immediate deduction. With grouping, without grouping, you have to defer that deduction. Scenario, sale of building only. Sell of the building only. You keep the practice and you sell the building. When that happens, if you do group, the losses on the sale of the building are going to remain trapped from other rentals. You may have gains from other rental. Let's say you sold that duplex down the street and there's a big gain. And let's say you sold your building LLC that you did group. You can't take the losses if your building that you operate in actually has a loss on sale. You can't take those losses and offset the gain on the sale of the duplex when you do the grouping. Now, the chance of you selling your building at a loss is probably pretty low. So I'm not too concerned with this scenario. Okay, let's go on to the DSO participation or transition where you bring on another owner. This, when you group it, it really adds complexity. When you don't group the building and your practice, it's quite a bit simpler there because having partitioned ownership between the building and the practice allows more flexibility in transitioning ownership in each one of those two independent of the other. So if you want to bring on a partner for your S corporation and give them 50%, but you don't want them to have ownership of the building, if you grouped, now you got problems. You're going to have to ungroup, or you give your new owner 50% ownership of the building anyways, which I always recommend that anyways. I do think you should have an alignment of incentives, an alignment of ownership between the building and the practice. Because remember, the practice pays money to the building. It's an expense. And if you have a partner of your dental practice who doesn't own the building with you, then there's going to be a conflict of what that rent rate should be. A conflict. That rent rate now needs to be a true market value. Where if your new partner also owns the same pro rata share of the building as they do the practice, if the rent goes up or down for tax planning purposes, then you and your partner benefit the same way. And there's alignment of incentives there. All right, and the last scenario here, passive income offset income from other rentals. So this again, I mentioned if you have income from that duplex down the street, if you don't group, you can then use that income and offset it from losses in the building. But if you group, you are not able to do that. Okay, so summary: when should you make the election to group your S corporation dental practice with your newly purchased building LLC? Recommended when the client is acquiring the building and plans to operate there long term. That's number one, acquires the building and plans to operate there long term. Number two, wants to harvest depreciation, especially through cost segregation, immediately. And number three, the dentist has no near-term plans for sale of the building or bringing on co-owners or co-investors in the building or the practice, unless that a new person is going to be another dentist owning both the building and the practice at the same ratio. With that, everybody, that is the final sum of cost segregation and the relationship between the income and expenses in your building LLC with the income and expenses in your S corporation. This is definitely one of the most complicated subjects I've addressed here on the Dental Boardroom podcast. If you don't own your building, ignore all of it. If you're planning on buying your building, listen to all of it, maybe 2 or 3 times. Until next time, everybody, have a great one.